Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to give an update on the current economic situation based off of Fed monetary policy and recent trends that have been developing in our markets. So this past week, the Fed decided to raise the federal funds rate by 0.75%, and that puts the Fed funds rate at about 1.75%. Now, as I've mentioned before, that's still very, very low, and these are still very generous monetary policies toward the current environment because they are so much below the interest rate. And even when you factor in the selling off of assets on the Fed's balance sheet, it's still not enough to compensate for the high inflation that we have right now. And so it risks that inflation could get out of control as consumers continuously borrow to spend and pay for goods, as well as the government itself. But one of the consequences of these rising interest rates is that we're starting to see the beginnings of a burst in the asset bubbles that have been developing for the past 13 years, ever since the 2008 credit market crash. And they have developed in several major areas, and we're just now beginning to see the unwinding on that. The first thing I want to go over is the corporate bond interest rate structure. So generously low interest rates have depressed corporate bonds for much of the 2010s, except for when we had almost a recession in the middle of the 2010s, around 2015 and 2016, and that was caused by the fracking revolution. So, the huge drop in oil prices caused a fallout in the oil sectors of the U.S. economy, oil production, because we found cheaper ways to drill and expand. But instead of putting us into a recession, the revolution brought down cost for production in other sectors of the economy. So we really just had a reallocation of resources and growing. But right now we're seeing the interest rates on the corporate bonds start to rise, and they're rising very quickly. So if we take a look in the last developments of the last year, we're really starting to see a strong uptick, especially in junk bond interest rates. Now, while they're not reaching anything of catastrophic levels, and I'll go into a couple of reasons why that's not manifesting just yet, this is the run-up. We're beginning to see the run-up in the bonds, and unlike what we had with fracking, which was caused by the development of a new technology, this run-up is much more similar to what we saw in 2007, okay? And so, in my opinion, we're in the 2007 era of the current business cycle. So we're probably about a year out, give or take, from a total collapse of the credit markets. Maybe a little bit more than a year, maybe a year and a half or even 2 years, but we're beginning to see the run-up in those bond interest rates. And so when these junk bond interest rates start to lift over 20%, that's when we really, really need to be very concerned that we're in the midst of a credit bubble. But by that time, there will already be other signals that have developed before then. And one of those is the crash in the stock market. So the stock market will already pull back well before then. It's already beginning to pull back now based off of interest rates. So let me go down here and show you my interest rate valuation model, which is in orange, against the stock market capitalization in blue. And you can see here how, based off of interest rates on the 30-year Treasury, GDP growth, against the actual stock market capitalization, how stocks basically trend with the interest rates. But when we really value the stock market as compared to private sector GDP growth, so if you take the gross domestic product and you subtract out all government expenditures and just take a look at what the realization of private sector income is net of government spending, you get what I believe is the real long-term value of the stock market here. And that's what this green line represents. The orange line is the stock market capitalization. You can see how grossly overvalued stocks are to the gross private product. But more importantly, the last two asset bubbles inside the stock market, those financial bubbles, when they collapsed, we saw a correction down to almost the gross private product level in 2001, and actually all the way down to the gross private product level in 2008. So more than likely, when this asset bubble does collapse in the financial markets, and I'll go into a couple of things that'll trigger that, we will see a massive collapse in the stock price. Right now, based off of my estimates, even with the latest correction that's going on in the stock market is still, relative to the gross private product, overvalued by nearly 3 times. So it's going to chop into 1/3, roughly speaking. However, the private product will probably continue to grow on a nominal basis until that collapse is manifested. So we really will probably see the stock market chop in half or a little bit more than half. But either way, it's going to be a devastating collapse, the likes that we have not seen since 2008. And it will probably rival from the peak to the trough more of what we saw in 1929 when stocks basically chopped in 4. That's a real problem. But one of the things I want to show you is the reason why we saw these massive overvaluations in the stock market was because the interest rate structure of the economy was so distorted by the Federal Reserve that it basically forced those bubbles. So you can see in the blue line here the interest rate valuation and how the stock market tracks with that interest rate valuation, distorting the stock market from its real long-term value by this green line, which is the gross private product trend line. So really, we're seeing massive financial capitalization rates, and it's just way overblown, and it's just built by excessive credit and money supply that has been going and feeding in to these financial assets for years. And now we're beginning to see rising inflation rates from that because of that excessive money printing. It's basically overflowing out of those financial sectors. And the rising interest rates, as interest rates continue to increase, they will depress those stock prices. And really, more than anything else, the interest rates will correct most of this stock market distortion. But as I said before, when the credit bubble does collapse altogether, we're going to see a final plunge in the stock market where it's all hell breaks loose and it just completely falls off the cliff right there. And probably what I do expect is that, much like what we saw in 2001 and during the early parts of the 2010s and the later parts, we'll probably see a variance between the actual interest rate valuation and the stock market capitalization as stocks are stubbornly dragged down from those rising interest rates. So there'll be a little bit of an overvaluation, but then when the credit bubble does collapse, it will destroy what remaining investment capital is left in the stock market, all the way down to this private product level before we can start an actual real recovery. The last thing I want to go over is Bitcoin here. So I have created a Bitcoin valuation model. I will admit, though, it's the weakest of the valuation models that I've created, but it's an interesting one. And the valuation is in orange. The actual Bitcoin price is in blue, and we've been seeing the bust in Bitcoin. And I guess I called that one correctly, that it was a bubble, and the real bust has been caused by interest rates. So the model is created by taking interest rates, taking the amount of transactions per month in Bitcoin, the amount of units of Bitcoin in circulation, the money supply, and factoring all of those together, you can create a model that more or less can give you a gauge on the real value of Bitcoin. It certainly called for the run-ups in the previous two Bitcoin bubble cycles that took place, one in 2017 and the other one in 2020. So had I created this model and used these factors before we saw this latest run-up, I would have been a multi-billionaire. Unfortunately, hindsight's 2020. I was only able to really gauge the accuracy and the status of Bitcoin after we saw the run-up in price. I did not have all the knowledge, I would say, to create such a thing until probably just recently here. But yeah, this Bitcoin model is certainly pointing to that rising interest rates are going to depress the Bitcoin price even further, probably down to below $10,000, depending on how high the Fed does raise interest rates. And then one other factor is that it depends on how much transactions are conducted in Bitcoin. So Bitcoin's transactions did peak in early 2021, but they've been on the decline since then. Now, I am forecasting that we'll probably get a little bit of a rebound in monthly transactions of Bitcoin and usage, but overall, it's not going to be enough to increase the price because essentially rising interest rates have pricked this bubble and will keep that depressed. One final bubble to look at is the housing bubble. There has been a housing bubble that has developed. This is my way of valuing it. So if you take the Case-Shiller Home Price Index and index it to the median wage earned, you can see here how the formation of the housing bubble in the early 2000s and its subsequent collapse brought on by the destruction of subprime mortgages and rising interest rates from the Federal Reserve. And we've been seeing an elevation in housing prices. So we were technically in a bubble, but now the bubble has really spiraled out of control and valuations are reaching rates that we have not seen since 2007 and 2008. A little bit of a difference is that we don't have the subprime mortgage issue that we had back in 07 and 08. But what I think will collapse this is the fact that we have a lot of big investment hedge fund companies that have bought into real estate because of value. And even though they probably plan on renting out those properties for income, when the recession hits and the income stream stop dropping, then they'll probably be forced to sell a lot of these properties. And even if that doesn't necessarily materialize from the inflation syndrome, a lot of these investment companies are invested heavily in the stock market and bonds. When we see the deterioration of their portfolios in the stock portfolios and the bond portfolios as part of their total portfolio, they may have to sell a lot of these properties in order to cover the losses that they materialized inside the stock and bond market, and that could precipitate the housing bust. When's that going to manifest? I'll get to that in just a second, so just hang tight. The big thing to watch out for that triggers a collapse in a credit bubble is obviously the rise in delinquencies and default rates. The two are tied together here. So this line here shows the delinquencies and defaults. Whenever you see them start to escalate sharply, that signals that a recession is coming from that collapse. And if you want to know what the marker is probably around the 20% threshold. So whenever you see a change in the defaults and delinquencies on loans by 20% or greater, and you don't see a subsequent sharp correction in the federal funds rate as the Fed tries to re-stimulate the economy and cover the collapse and paper over the collapsing debts with more money, which is what happened in 1987 and why we did not get a recession then we will enter a recession. It will be corrective in nature and it will liquidate those bad debts. It will cause a rise in unemployment and you'll see a collapse of the credit market. And as I've pointed before, when you take into account the huge overvaluation in the housing market, the huge overvaluation in the stock market, and other types of asset bubbles like what happened in the digital assets of cryptocurrencies, we're looking at a massive, massive correction from all that distortions. So I've mentioned this on the videos before. I've created a debt default model that sort of forecasts pretty accurately when we're going to see the rise in delinquencies and defaults on loans. And it's essentially when the debt levels and the interest rates reach such a high threshold against GDP that we will see the collapse. I've created 3 different types of models. The original model was just using the bank prime loan rate, which is based off the Fed funds rate, and total loans and in the economy against GDP. I've created a new model to sort of take into account other systemic issues. So I've kind of broken down the debts and their various interest rates to try to take into account that there are longer term interest rate structures in these loans and factor that into the model, which has been pretty predictive. And it's probably going to be a little bit more sensitive because we're seeing interest rates rise on the longer term spectrum as well as on the shorter term spectrum. Long story short on this, it looks like the threshold will be breached sometime in middle 2023 as long as the federal funds rate is lifted up to above 3.5%. So that's your trigger right here. If the Fed raises the federal funds rate to 3.5% or higher, then we will subsequently in the coming quarters see a breakdown inside the rest of the aggregate economy as we go through a huge credit bubble burst. It'll be too much debt at those interest rate levels for our economy to handle, and we will go into a full-blown recession. Now, that doesn't mean we're not going to have a recession in the short term. We probably will, but it'll be caused by a run-up in price inflation, not by the rise in delinquencies and defaults. When we take a look at the delinquencies and defaults right now, year over year, they're at generous lows, and that's because of the previous low interest rates, record low interest rates that was there by the Fed, as well as government policies to stave off debt defaults, such as deferring mortgage payments and rent payments during the COVID pandemic. So we'll see these start to rise subsequently, but again, my beginning threshold for this is probably going to be in 2023. That'll probably be the bottom. And if that does materialize correctly, then we'll start to see the rise in those delinquencies and defaults on loans. When that happens, that's when we'll probably see the collapse in the housing market and the remaining collapse in the stock market. Now, one last thing to note here is that we've been seeing a record rise in the US dollar over the past year. So the dollar has appreciated by 15% against other currencies in the last year, despite record high CPIs. And one thing to note there is that, in my opinion, has been a big factor into depressing the gold and silver price. So when we take a look at gold and silver for the last year, they've either been flat or declining. Well, gold has been in a slight uptrend, but again, that pricing structure, we're not going into that bull market because we've been seeing this run up in the dollar. So somebody somewhere is buying US dollar denominated assets. They're not buying treasuries per se, unless if it's domestically, but it's possibly that international investors are abandoning their own currency denominated assets to buy dollar denominated assets, even during a falling environment. However, because the losses are materializing in the stock market and are beginning to pick up steam, I believe that if we don't see it now or in the near future, when the credit bubble collapses, we might see a collapse in the dollar and a regression back down to its original median, down to about, say, where it was on an index level of 91, 92. But if we do, that will cause an automatic 15% jump in gold, maybe even 20%. And if that were to happen, I believe that would hallmark the beginning of the gold bull market. So that correction in the stock market plus the correction in the dollar will push up gold and silver. But because of that, we may be seeing a relative stagnation or a slow movements in the gold and silver price until the latter half of the 2020s, when the bust fully materializes. So keep on the lookout for that. And guys, that's all that I have for this video. I hope that you enjoy this content. If you have any questions on this, let me know. If you like the content that I provide, always show me the support. Like my channel, or like the video. Subscribe to my channel if you haven't already. Click that notification bell. And you're always welcome to share this on any kind of social media as you deem fit. And as always, I'll keep you updated and appraised of what's going on in our situation as our market dynamics continue to develop. Once again, guys, I thank you for watching this video, and I'll talk to you next time.